Good to go. Evening, folks. Before we start, I just need a few confirmations whether you can hear me, whether you can see me and Randy both on the screen. Okay, a few more. So that will take care of all the network issues, so on and so forth, anything that we are probably looking at. Super. Great, guys. Great, guys. Thanks a ton. Thanks a ton. So let's start off. A few more people are joining in, but let's start off for the paucity of time. So evening, folks. Mayuresh Joshi, Head of Research at William O'Neill, India. It's a pleasure to connect with all of you. There was a gap of a couple of months, but we kept that gap purposefully because we wanted our very own special guest to start off the new financial year with all of you. And here we have it. All of you are familiar with Randy Watts. You can see him on the screen, top left corner as well. He's the Chief Investment Officer at O'Neill Global Advisors. He's been associated with the firm for a pretty long period of time. He's also attended the University of Virginia and graduated with a degree in American Studies. He followed that up with a CFA as well. Obviously, I think Randy's got a long track record in terms of managing both long-short hedge funds as well, mutual funds. He's previously worked with Ojo Hill, the Boston Company, Westfield Capital Management, to name a few. So Randy, welcome. Good morning. It's pretty late here in India right now, but good morning to you. And thank you so much for taking out time and speaking to all the wonderful folks out here in India.
Well, thanks for having me on. Thanks everybody for staying up late. Hope everyone's doing well in India. Obviously, the pandemic's still an issue, so if you're not vaccinated, get vaccinated. But I hope everybody and their family is safe and doing well. Absolutely.
Thanks for that message, Randy. So I think the first question, and let's jump right to it. I think the global markets are in a bit of a tizzy right now, what we are seeing every night. And we've got this peculiar fascination of tracking the US markets, specifically the NASDAQ and the Dow, and how they are ending the day there. And it seems to be that the distribution day count, as per our O'Neill strategy, is actually building up for the US markets, for a lot of the developed markets as well, and a lot of the Southeast Asian markets as well. So in the first place, how are you viewing the market status? What do you think, is it an inflection point as far as the US markets are concerned?
Okay, I would say a couple of things. The first is, most importantly, when you think about global markets, they are interconnected. And when the really big countries, in particular the US and China, when those countries and governments add liquidity to the system, it affects all the markets globally. And when they contract liquidity, it affects all the markets globally. I don't want to say anything on this call that makes all of our viewers and listeners think I'm so focused on the US, I'm not aware of the rest of the world, okay? But you should think about the Fed and then kind of China and Japan, et cetera. But you should think about the Fed almost as the world's global bank, okay? And when the Fed, during the pandemic, took its balance sheet up so much, basically went from 2 trillion to 8 trillion, it put a lot of liquidity into the system globally. And now the US Federal Reserve is starting to drain that liquidity. Now, what's important is that it actually hasn't started to drain the liquidity yet. It is raising rates. It's already done one raise of 25 basis points. You're probably going to get another raise. It's probably going to be 50 basis points this week. But in addition, it's going to start to reduce the size of its balance sheet. And it's going to be doing that by letting its investments primarily in fixed income run off without reinvesting any of the money. And over a 3-month period, it wants to ramp that up to a $95 billion US rate per month. That would equal 1.1 trillion in balance sheet reduction over 12 months. So that's a big change, and it's just starting right now. When liquidity drains from the system, that's generally a negative for stocks. In particular with the Indian market, one of the negatives short term, and we'll talk about this later, short term is that it's likely to keep moving the dollar higher. The dollar is very high right now versus the general basket of currencies. That tends to put pressure on foreign markets, particularly markets like India. So the first thing to think about is that we were in a major global easing cycle. Now with the Fed, we're actually in a tightening cycle, and that is usually a tough time for stocks. It also usually correlates with higher rising interest rates, which we are seeing in the US. So my first comment about the global markets is that this tightening cycle is going to make it tough for stocks over the short term.
Fair enough, Randy. So I think the next point that you probably raised in your opening remarks as well, the Fed itself, right? I think it's a key indicator on how global markets behave. Now, is the 50 bips hike that is expected in May largely penciled in, and a few more hikes in the coming months as well? And if liquidity gets drained out of the system, and with the tech earnings that we probably see on NASDAQ, what is the general mood? I think is the best for equities largely over for this financial year, to say the least?
I think what's going to happen with stocks is that the market's going to be under pressure in the US and maybe globally until the market can start to see, this is going to sound very esoteric, until the market can see the end of the tightening cycle. So the end of the tightening cycle doesn't have to occur. The market just has to be able to visualize where it is. Right now, we're not there yet. So I think the summer months could be a very tough time for stocks. But given what's going on in the world, the horrible war in the Ukraine, the spread of COVID in China, which we'll talk more about later, where they are locking down a significant portion of the population. And remember, China is the second biggest economy in the world. There's a lot of downward pressure on the global GDP growth rate. Both the IMF and the World Bank in the last 2 weeks have cut their estimates for global growth this calendar year. So I suspect that the Fed is actually not going to have to raise rates as high or as long for as long a time period as everyone initially thought. There are already signs in the US that the US economy is decelerating. Remember, last week, we found out that the first quarter GDP for the US economy actually shrank in Q1, which was a big surprise to everybody. And housing, which makes up about 17 to 18% of the US economy, saw home sales fall over 8% last month in the month of March. So the US economy is slowing, the global economy is slowing, and this may mean that the Fed does not have to raise rates as high and as long as initially thought. That would be bullish for stocks. I could see a period late in the year where it appears that we can start to see the end of the Fed cycle. That doesn't mean they're done raising rates in 2022. I hope I'm not being confusing here. That doesn't mean they're done raising rates in 2022, but if the market thinks they're going to be done raising rates by, let's say, the middle of next year or the end of the first quarter next year, stocks will start to go up again at the end of this calendar year. I just think we're a little early on that. Remember, the Fed hasn't even started to drain its balance sheet. That's starting in May. That's starting this month. So I do think in the short run, the outlook for equities is negative because of declining growth globally and because of the Fed tightening.
Point taken, Randy, which brings me to my next question. If there is short-term pain in equities, bond yields at a record high at this point of time globally, is there a clear rotational path towards bond yields to begin with? Or probably there is some sector rotation within equities as well?
You know, there's been a big move over the last couple of months into cyclicals and commodities and stocks that benefit from inflation. But if this all plays out how I think it will, there'll be a point in the next 12 months where you're going to be wanting to buy growth stocks again. Because I think the Fed tightening is eventually going to lead to slower economic growth, and that is going to encourage investors to buy growth stocks again. I don't think that moment is quite here yet, but I do think the slowing macro outlook means eventually you're going to be favored to buy steady secular growers again. So, and with regard to bonds, bond yields have probably not peaked for the cycle. They are going higher. I think you will see some money as yields climb move from stocks into bonds. Remember, in the US, real bond yields, which is the nominal bond yield minus inflation, was decidedly negative for the last several years. As those rates move positive again, some money that was in stocks is going to move into bonds. So I do think we'll see some of that asset flow. I'm not sure how long that lasts. Obviously, it lasts until the market begins to sense a peak in bond yields, but that peak in bond yields is definitely not right now. I'm not sure if it'll be this year or next year. It'll probably be in 22 or 23 that bond yields will peak. But right now, yields are probably still headed up, especially given what the Fed is likely to do. The market has a forward curve that basically predicts where yields are going. It's almost like you can think about market participants betting on what the Fed is going to do. And right now, market participants are betting that the Fed is going to do 50 basis points in May and another 50 basis points in June. So if the Fed does 100 basis points over the next 60 days, bond yields are moving up, especially in the intermediate term.
Oh, absolutely. And if this scenario does pan out, as you're saying, does that mean that a lot of foreign institutional investors who are invested in India, as an example, or other emerging markets, does that mean there is an exodus towards the dollar or towards US bonds in the short to interim period as well?
I think historically, a very, very strong dollar, makes it tougher for emerging markets because of the currency translation. Yeah. What's tough about international investing is you can get a market or a company correct in terms of your investment, but if you get the currency wrong, you can still lose money.
Yeah.
So for the US dollar-based investor, if the rupee devalues versus the dollar, that US investor can lose money in the Indian market, even if the Indian market doesn't go down.
Yes.
So I don't think the dollar is done with its move upward. I don't think the dollar's peaked personally yet. Okay. So I think that's going to put pressure on a relative basis on the Indian market. However, we still think, and I'm not saying this to play to the audience, we still think the Indian market in India is one of the best secular stories in the world right now. And over the next 5 years is going to be a great place to invest. And as you and I were talking about before we went live, that's really for two reasons. The first reason is that there is secular growth in India. India has a rising middle class, which is going to continue to increase domestic consumption. And that is going to lead to overall a strong economy over the next several years. So I think that's dramatic. And then the other thing is that businesses are going to be shifting production out of China to other markets. And the market that's probably going to help the most is India. Now, that doesn't mean US production is going to zero in China. And I'm just making this up as an example. But if you were a company that had 65% of your production or your supply chain in China, maybe that's going to 50 or 45%. Some of that production or supply chain is going to come back to the US or Europe, but some of it's also probably going to go to India if there are Indian suppliers who can fill that need. So I think that is really going to benefit the Indian economy. That is a multi-year trend. I would say one thing investors should think about is that a lot of the trends that are occurring right now are not short-term in nature. So in other words, if the war in the Ukraine ends tomorrow, that doesn't mean everyone starts buying Russian energy again. If again, the war in the Ukraine ends tomorrow, it doesn't mean that everyone is going to put all their production back in China. I think what has happened over the last 2 years has concerned corporate managements enough that they are going to be shifting some of this production regardless. And the two follow-ons to that are a lot of countries, including Europe, are going to want to diversify their energy stream away from Russia. And a lot of US-based, European-based manufacturers want to diversify their supply chain away from China. I think companies and countries have realized that level of dependence in Russia and China is a risk. And even if things kind of quote unquote go back to normal, it's not going to change the fact that they're going to diversify that.
Absolutely. I think that's very encouraging to hear, Randy. I think a lot of people will be very happy to hear your thoughts on the Indian ecosystem and the opportunities out there as well. Now, you drove home a point about inflationary risks and inflationary concerns as well. I think that's the hot word right now, locally and globally as well. How do you see the inflation trajectory, both in the US, for India, as well as the risk in terms of global equities as well?
I think inflation has likely, well, let me say two things. First, I think inflation has likely peaked. But just because it's peaked doesn't mean it has to come down rapidly. So I do think things are starting to free up. I do think that prices are going to start to come down slowly. But if they move from, 7% to 5% or 5.5%, that's still very, very high inflation. So while it may have peaked, we're not going back to the regime we were in pre-pandemic in terms of inflation. Let me say two more things here. One area I'm particularly concerned about, which is an issue for India and for many countries, is food inflation. I think food inflation is a multi-year theme. I think it's going to be a problem globally, particularly for places like Africa, over the next several years. So there's a lot of issues with food production. Again, the war in the Ukraine ends tomorrow. It's not like wheat production all of a sudden goes right back to where it was. Yeah. And Ukraine produces a lot of wheat, especially for China. Yeah. So food inflation, is really gonna be an issue. In terms of energy inflation, I think that'll start to normalize over the next year or so, though I think oil is still going to stay high relative to where it was a year ago. The way I think about things is, for both inflation and interest rates, you were in a trading range before the pandemic, and maybe the low end of the trading range for inflation was, 1 to 2%. And that high end of the range was, 3.5 or 4. Yeah. And for interest rates, pre-pandemic, the low end of that range was kind of 2-ish, and maybe the high end of that range was 4 for US interest rates. Yeah. I feel both of those trading ranges have now moved up. Okay. And they've moved up on a secular basis. So I personally believe we've seen the low. I'm making too many predictions on this call. It's going to probably come back and haunt me. I think we've seen the low in interest rates for my lifetime. So remember, the US 10-year got to 0.5% or 50 basis points during the pandemic. I don't think it's ever going back there. Okay. So I think the new trading range, maybe the new trading range is 2 to 2.5 on the low end for US rates, up to 5, let's say. Okay, so still not extreme, but it's shifted up. And the same thing with inflation. The Fed likes to have a target of 2% inflation. I think it'll be years till we're back to 2% inflation. Doesn't mean we're going to stay at 7 to 8, but maybe the new range on inflation is 2.5 to 5. It's not 4, 3.5 to 1, right? So both of those have moved up. Both of those suggest over time lower price earnings multiples for equities, and probably higher yields and a little bit more attractiveness on bonds relative to stocks. Doesn't mean I like bonds over stocks, but it means that when the US 10-year was yielding 50 basis points, there was no reason to buy a bond at all. If we get to this new trading range, in the mid part of that trading range, it actually makes sense to have a little bit more bond exposure. I hope this is kind of rambling, but I hope this all makes sense.
Oh, no, absolutely. It makes a point. I think, folks, I hope you're clear on what Randy is saying, right? When interest rates are low, there is no evident interest of corporates or institutions to get there because the yield itself is very low. As they start moving higher, the yield factor starts moving higher. Point absolutely taken, Randy. To come to the point, then again, I think if this is going to be a sticky issue, both in the US and on global fronts as well.
Yes.
For the US market in particular, I think, obviously, I was reading through your Forbes articles as well, your monthly articles as well, and you're betting a lot in terms of healthcare as a sector and hotels or tourism as a sector as well. Are these two more inflationary hedge kind of sectors where inflation doesn't hit that hard and earnings are stable?
They're kind of different. With regards to healthcare in the US is relatively recession resistant. We are nervous about the US economy. Also, a lot of people did not go and get their normal healthcare treatments during the pandemic because they were worried if they went to their doctor, if they went to the hospital, they would get COVID and get sick. So a lot of elective surgeries and procedures, and not even just elective, a lot of visits and procedures, et cetera, were put off or delayed or canceled during COVID. So we think there's a tailwind to healthcare utilization in the US as we move through the pandemic. So we think that's the first thing that's good about it. The second, again, is, as I said a minute ago, it tends to be recession resistant.
Yeah.
Also, a lot of healthcare stocks are trading at reasonable valuations. We like buying growth stocks here right now. And so we find that a very attractive place to invest. Now, travel is totally different. The US government gave out a ridiculous amount of money during COVID to the bottom, half or third of the United States consumers. The top part of the US consumers saw an increase in their wealth from a rising stock market and rising home prices. So the consumer balance sheet is in better shape right now than it was pre-pandemic. So the US consumer balance sheet is in better shape now than it was pre-pandemic. And people have been locked up and restricted for a long period of time, and they want to go out and travel, and they're not completely price insensitive, but they're more willing to pay a higher price than they were pre-pandemic. And we are seeing in the results from the airlines that have reported, United, American, Delta, that demand is very, very strong. You can't get on a plane right now without the plane being completely full in the US. Hotel bookings are very, very strong. I think there may be some reluctance because of COVID and because of the war in Europe for the US consumer to travel overseas this summer, but I think demand for travel around the US is going to be extremely strong. And one of the places the US consumer is going to spend their excess savings is in travel and experiences this summer. I think once we move through the pandemic globally, this is going to be true all over the world. And so we feel like that is a very strong theme. And the results so far for the first quarter have borne that out. I know this sounds contradictory that I say I'm worried about the US economy, but I like travel. But I just think over the next couple of quarters, people in the US are going to travel and they're going to spend some money. And that is one of the places they're really going to spend it.
Absolutely, point taken. The other perspective I wanted, Randy, from you is about tech companies. Now, US tech companies have been hammered out of shape, both because of results or maybe over expectations in terms of earnings. But how do you stack up tech companies in the US and tech companies in India? I think the models are absolutely different because Indian companies are outsourcers, but they are getting hammered as well. So with a depreciating rupee against the dollar, and the tailwind for these companies in terms of more order wins, expectations of more resilient earnings growth. Do you see a differentiating factor between tech companies in the US and tech companies in India?
Well, I do. Let me first say, we like the Indian technology outsourcing and BPO market. If you look at the way the quarters are coming in for those companies, bookings for both sectors, so new contracts signed for future business, are still rising in the high teens. So the demand for services is very, very great. Now, as is often the case, especially in India, there is some margin pressure there, especially on labor rates.
Yes.
But revenue growth and bookings are still very strong. The major companies like Tata, et cetera, are reporting very good numbers.
Yeah.
So we still really like those stocks. And even though they've pulled back this year, we think those are stocks that Indian investors should consider buying and holding for the long term. Okay.
Yeah.
I mean, one of the stocks we own in one of the products I manage is EXL Service.
Yeah.
Continue to like that. About 45-50% of the business is based in Indian assets. We still think that's a huge growth area. They support a lot of the financial services. So we still really like both Indian BPO and Indian tech outsourcing. We historically have really liked Infosys as one of our favorite names. Their backlog continues to rise. I know the stocks have been rocky. There is some margin pressure, but I think over the next several years, those are going to be good stocks. With regards to, and also, they are going to continue to benefit from a shift of outsourcing out of other foreign economies and into India. India is a very trusted partner for US corporations. I think that's going to increase, not decrease. So I think they're going to benefit from that. Maybe not as clearly as some of the Indian manufacturing, but they're going to benefit from that.
Yeah.
And so continue to like it. With regards to US technology, we still think long-term, the leadership in the US market is innovation. We still think the US technology industry is the innovative leader of the world. So I don't mean to say, sound too pro US, but with this particular industry, I still think we're the leader there. It's a very, very stock specific case by case basis. So one of the stocks I own personally, and we own in some of the products I manage, is Microsoft. So Microsoft had a great quarter. Okay. It's a $2 trillion company growing in the teens on the revenue line. Profitability is very good. They have a ton of cash. They're number 2 in cloud services and outgrowing the market. They're doing well with their Office 365 online product. They're in the process of trying to acquire Activision, so they're really a leader in video games. They're doing a lot more work for the US Defense Department. They're expanding rapidly in security. So I look at a stock like that, which has come down, and personally, I think it's a very attractive stock. Again, caveat, I own the stock personally, and we own it in products at O'Neill that we manage. So I want to be very clear on that.
Sure.
But I think that's a very attractive stock over a multi-year basis. So I think it's very stock specific, and it's tough to make a big generalization about tech. I mean, another area we like semiconductor equipment companies like Applied Materials, Lam Research, KLA. A lot of fabs, a lot of semiconductor fabrication facilities are going to be built outside of China.
Yes.
over the next several years. Intel is building a huge plant in the US, in the state of Arizona. I think you're going to see more fabs constructed in places like Europe, the US, I would suspect somewhere like India. And I think there's going to be a lot of demand for equipment. Those stocks have pulled back. I think those are very interesting and attractive stocks. With regards to the internet, it's very stock specific. I think some of the social media advertising driven companies have obviously run into some headwinds. I know Google had kind of a poor quarter. The long term, we think their dominance in search and the way they've been able to transition that business to mobile is positive. So I do think that's a pretty attractive name. On Apple, I know they had a relatively decent quarter. They're doing a huge buyback. We are still very nervous about the Apple supply chain, and we're nervous that about 18 or 19% of revenues come from China, which we think are going to be under pressure in the quarter we're in. One thing for all of our viewers to think about, a lot of the problems in China and the war started in Q2, not Q1.
Yes.
So I think Q2 is going to be a lot trickier for companies to manage than Q1 was. So, we do have some anxiety, and though we still own the stock in some of our products, we do have some anxiety regarding Apple. So I think you'd really want to look at companies, US tech companies right now that don't have supply chain issues, which is one of the reasons we think software is attractive.
Yeah.
And where we feel like they're going to be able to put up good numbers over the next couple of quarters. I would note the US software industry has gotten hammered so far year to date. If you want to look at a chart you can look at is IGV. That's the US software ETF. That has had a huge move down.
Yes.
I think that is an attractive area. Another area we think is attractive is payments. A lot of those stocks have gotten crushed. Stock that I own, which I guess I shouldn't have, but a stock that I own personally is PayPal. That stock's gotten annihilated. I think that is getting very interesting in terms of its valuation.
Yeah.
Obviously, Square is down a lot. The credit card companies like Visa and MasterCard have come down. So I think the whole payment space is actually pretty attractive and should do well over the next couple of years. But if you're looking to buy US growth stocks, I would focus on companies that have earnings and are currently growing both their earnings and their revenues. I would not be speculating in story stocks that are losing money. I think now is the time to try to upgrade your portfolio. And if you don't own some of these very profitable, large cap growth stocks that have good earnings and revenues, now is a good time to start to slowly move into them, with the understanding that it's entirely likely that the US market has not seen its bottom yet.
Absolutely. That was very, very insightful, Randy, and very, very comprehensive as well. So thanks, Adlan, for that. Now, in the same context, when it comes to India, as the world is grappling through all these macro issues and micro issues as well, is healthcare stroke hospital stocks, stroke hotel stocks also very attractive theme as far as the Indian market is concerned, or are there more themes that you're probably looking?
I think they are attractive in India. A lot of the attractive Indian names are actually in the generic space. Some of those have been under pressure over the last year. I think that's in an industry that as utilization moves back up globally, they're going to do better. So we still like a lot of those Indian generic drug manufacturers. There's a couple of major hospital groups in India that I think are going to do better over time. Again, it sounds ironic, but the hospitals were filled with COVID patients that prevented or squeezed out a lot of the other patients that would normally go, that actually hurt the hospitals and put pressure on margins. As we move to a more normalized healthcare environment, I actually think those should do much better. Another theme that we really like is we like green energy, and we like electric vehicles. One of the names that we think is interesting in India is Tata Motors. They're one of the leaders in four-wheel. By four-wheel, I don't mean all-wheel drive. I mean,
Yes.
Cars. They're one of the leaders in EV there. There is a huge push between now and 2030 to increase the percentage of EV vehicles in India. We think that is going to happen. We think Tata is one of the leaders there. This is real. It's going to occur. That's an area we like globally. We like it in the US. We like it in India. We also like some of the battery producers and the producers of lithium, which is in shortage right now. And we also like the major clean energy companies. Tata Power is making a big move there to create more electricity generation using clean energy. We think that's going to continue. It's definitely going to continue in India for two reasons. One is pollution, and the other is there's a huge demand for more electricity. As you all know, in the Indian markets, they're going to have to build capacity. And given where fossil fuel prices are now, the gap between building that renewable plant and building that fossil fuel plant is narrowed. So if it's narrow enough, and you're going to decide to go ahead and do the green one because it's going to benefit you more in the long term. So Adani Power is another name we like in India. And so hopefully I pronounced that correctly.
Yeah,
and so, we think that's a major theme. So when I think about themes we're excited about over the next couple of years, one is travel, one is definitely green energy and EV. One is actually, we just think globally, is actually security, cybersecurity, we think is a huge theme globally. There have been a ton of hacks. Now states like Russia, et cetera, are starting to use hacking as a national strategy to push against their opponents in the geopolitical sphere. And so we think cybersecurity is going to continue to be an area that is more and more important and a real growth area globally. Many of the companies in the US that are in that area are growing their revenues double digit. We think that's going to continue.
Wow, super. Now, since you mentioned EV, I think just to follow up, Randy, on the EV theme itself. Now you're seeing rollouts happening across the globe in terms of a few two-wheelers actually taking the initiative. But we also had a lot of instances of batteries heating up and two-wheelers actually exploding. So I think that's
Yes.
not a good sign. But generally, I think when it comes to the OEMs, I think is the preference both locally and globally with OEMs or more with the auto ang players who are probably making this entire ecosystem happen?
I mean, in general, we would prefer the parts manufacturers or either the commodity supplier with lithium or the person making the battery.
Yeah.
With regard to the end units, in China, in India, there's a lot of two-wheel manufacturers, so that's a little bit more of a competitive market, which is why we'd favor the four-wheel. The two-wheel and the three-wheel market is very competitive, so we think there could be some margin pressure there.
Sure.
So in general, we prefer cars, not bikes.
Okay.
And in general, we'd prefer the parts manufacturers or the battery creators to the end suppliers. But that being said, as I mentioned earlier, we do like Tata Motors. We think that's a pretty interesting company, and we think they're doing a good job in terms of expanding their product line into EV.
Great. And about lithium miners and producers, any global names that you're looking at?
One name we really like in the US is ticker LTHM, Livent, which is one of the bigger manufacturers of lithium. There is pressure on that market. There is a lack of supply. We think that's going to continue over the next several years as EV production increases around the globe. So many of these countries, the US, India, Europe, have put in guidelines for the percentage of vehicles they want to see be EV over the next 20 years. And so we think that's really going to push demand. And so we think that's actually a pretty good place to be if you can take a little bit of a longer horizon. Again, sales may be a little crimped this calendar year because of parts issues. For example, one of the things that's kind of funny, the Ukraine produces a lot of wire harnesses for cars.
Yes.
Who knew, right? And that is continuing to hurt production on a lot of European and US brands. Ford in the US, for example, told all their dealers last quarter that they expect actually less production deliveries in 22 versus 21, and 21 wasn't that great. So there is going to be a supply chain issue for auto globally. But I think as we move through that and you look longer term over the next several years, those should be okay places to invest.
Absolutely. I think just to follow up on this one, Randy, I think you spoke about semiconductors, right? But semiconductors still seems to be acting as a headwind. When we hear a lot of conference calls post earnings, they say it might start receding from the second or the third quarter. Do you think that's a fair analysis or an estimate to make?
I think it's a fair analysis. I think the other question is what's demand going to look like when you get to that point? I think one of the reasons the semi stocks have been doing worse recently is not because of continued supply chain issues, which definitely exist. I think people are starting to now worry about the demand side of the equation, especially if you're selling into China. So I think there's kind of both problems there. I think there's a supply chain issue, but there's also a demand issue. I think clearly global economies are weakening in China, Europe, and in the US. In Europe in particular, energy prices are up so much that I don't see how, let me rephrase that instead of using a double negative. Energy prices are up so much in Europe, I think that has to affect consumer demand. And I think that's obviously a risk to consumer spending in Europe.
Absolutely. Point taken. Just a quick mention on the renewable side that you made. You did speak about Tata Power. There is a massive shortage of coal in India. There are power cuts and outages that are happening. But I think is that entire transition from fossil fuels, from thermal to renewables, I think it's going to take time, right?
Yes.
So to fill this gap, right? How are earnings going to stack up? Because you're going to have a lot of capital expenditure that you're probably going to do, and that capex might be front loaded, and the earnings might be back ended. Still, these renewables make sense in this entire argument.
And renewables definitely make sense because the higher those fossil fuel prices go, the closer the renewable plant gets to parity with the fossil fuel plant. There is a coal shortage. There's issues with natural gas, though I believe, correct me if I'm wrong, India is still buying natural gas from Russia. So
and then Qatar.
India may actually benefit from the fact that Russian gas is going to be trading at a discount to the global gas price. So that could actually maybe help some of the utility players that are buying in that gas. I do think there's going to be pressure on fossil fuel prices the next couple of years. I think that actually encourages the shift to renewables. I think it's possible that there could be a little bit of a margin shift. Off the top of my head, I don't know exactly how power rates are regulated in India. I don't know how the government regulates the electricity, per watt pricing. But so I think there could be margin pressure there, but there's so much secular demand. They're going to have to build so many more megawatts, but the absolute capacity, especially of a guy like Tata Power, is going to grow so much over the next couple of years that even if margins compress a little bit, I still think you see higher revenue and earnings growth. So I still think it's attractive on a multi-year basis. I do agree that for calendar year 2022, there could be some margin pressure from fossil fuels being in short supply.
Absolutely, point taken. Just to answer your question, Randy, I think on the tariff capping part, I think we've got ultra mega power plants. We call that UMPPs, 4,000 megawatts and above. What the government has done is when they called for tenders, they said that you estimate a cost that you can probably put in or peg per megawatt. So a lot of companies had put in a cost, but that cost, as you rightly pointed out, has gone through the roof. So the cost has increased, but the end prices, unfortunately, because it gets capped, I think there is going to be a lot of fixed cost overruns. Nevertheless, let's get to the other aspect. I think commodity prices, you did touch upon that, and commodity prices have gone through the roof, both ferrous as well as non-ferrous. So if I ask you in a selection mode, do we like commodities as a space? If we do, is it the ferrous or non-ferrous part?
Do we like commodities as space? It depends on the commodity. So, we like food. I mean, unfortunately, food inflation is going to be a thing for the next several years globally. That's of all the commodities, that's the one and it's too bad, but that's the one I most strongly believe in terms of the price trend. And food inflation is not something you can fix easily. And it's not like there's some massive food producer who's about to come back online. So food inflation is going to be a thing that's going to lead to probably good same-store sales results for grocery chains and restaurants, but it's likely to actually hurt their margins. So we believe in food inflation. I think wheat is up, 35 to 40% this year already. So we believe in that. With regards to energy prices, they're going to stay high in the sense that I don't think they're going back to kind of the pandemic low, but I also think we're probably at the near the top of their trading range right now. So I think as things resolve themselves, it would not surprise me to see oil move back below $100 a barrel, which it was just a week or two ago. That's all. In the short run, there's going to be pressure on natural gas as Europe stops buying Russian gas and have to look elsewhere. LNG prices are probably going to rise, and the U.S. is going to be a bigger supplier probably of LNG to Europe.
Okay.
I do think energy prices, we talked before about trading ranges.
Yes.
I think the trading range on fossil fuels has moved up, but I suspect we're kind of at the high point of that trading range right now, and I would expect those to settle down. With metals, it's very, very metal specific. The action in the steel stocks recently, and maybe that correlates to auto production. Those stocks have started to correct a little bit. So I'm not sure how strong steel demand is going to be over the next couple of quarters. Copper has started to weaken a little bit recently as well. I think we've mentioned it several times already. I think lithium is going to stay in demand. I think rare earths, which China has a huge market share of, and there's very few major companies outside of the Chinese market that produce rare earths. I think those prices are going to stay high. And I think a lot of manufacturers are going to be looking for a second source besides Chinese sources there. So I think that's going to help pricing. So it's tough to say, and I would encourage our viewers to make just a broad comment about all commodities or all metals. It really is very specific to each commodity in each metal. So for example, lumber, I think lumber prices are likely to pull back here. Housing starts are likely to slow in the US. Housing sales are slowing. Mortgage rates have moved up dramatically in the US since the beginning of the year. And so that's going to dampen demand. So again, it's very specific, and not to be overly repetitive, but if I had to believe one set of commodity inflation, I believe food, sadly.
Yeah, sadly. But again, I think so. So food and lithium is something that
Absolutely. And rare earths. And rare earths
is what Randy is betting on. Now you mentioned also in one of your remarks on the China plus one theme that might benefit a few sectors as far as India is concerned. So I think, again, it's a very broad perspective on textiles and specialty chemicals. But these two spaces with this theme in focus, you like these spaces as well?
Yeah, absolutely. Textiles is definitely going to shift. Their capacity in textiles is definitely going to shift to India. It's also shifting some markets like Vietnam. But that is, China's a huge producer of textiles. Some of that's coming to India. That's definitely going to be a beneficiary. That's one of the places we like. We think, again, that supply chain is going to diversify. A lot of these supply chains are going to diversify. It's just a question of how quickly. You look at a city like Shenzhen in China, which is, right next to Hong Kong. It's, the second biggest city in China, which produces a lot of the tech supply chain. I mean, that's going to stay pretty big and dominant for a while. But over time, people are going to try to reduce their exposure to it and move those supply chains to the U.S., to Europe, to India. So this is all gonna happen, and India is going to be one of the main beneficiaries. We like textiles. We like specialty chemical. Specialty chemical, it's a little bit like we just talked about with the Indian power companies. Demand for Indian specialty chemical is very, very strong. But specialty chemical producers are big consumers of fossil fuels, in particular oil.
Yes.
And so they are seeing a lot of margin pressure right now. So there's a lot of companies in India and industries in India where we feel good about the long-term demand and we feel good about the revenue growth. The question in the short run, and I define short run as over the next year, is how are the margin structures going to hold up? The issue with some of the specialty chemical stocks in India is that their margins are going to be under pressure. Their gross margin is going to be under pressure because their input costs are rising so quickly right now. And you're probably really going to see that in the second quarter results.
Well, absolutely. Absolute valid point, Randy, that you put across. Now you have to ask you this.
Sure.
Financials. How do you stack up financials, specifically in the rising interest rate scenario, globally as well as in Indian context?
I mean, we would favor the insurance companies, particularly in India. So far, if you look at the banks, so first of all, we like the insurance companies, HFC, et cetera. We like the insurance companies. We would favor those over the banks. They tend to have a more positive R squared with rising rates than the banks do. So we prefer insurance over banks. With regards to banks, so far, credit growth has been pretty good in India. It's been high single digit. I don't have a great read on how I think that's going to progress over the course of the year, or what credit quality is going to do in India. On a secular basis, on a multi-year basis, they should be good investments for two reasons. There is going to be a lot of credit demand over the next 5 years in India as the country expands and as the middle class rises. And also, as I mentioned earlier, I believe we're in a higher interest rate regime than where we were. Over time, that should lead to better net interest margins for Indian financials. That being said, I don't have a good sense of what I think loan demand is going to be for the rest of the year in India, and I don't have a good sense of what credit quality is doing. If you look in the US, credit spreads are starting to widen. Now, they're not at the point where people are panicked about defaults really taking off, loan defaults, but they are widening. They are going the wrong way. And I think that's a trend that's likely to continue as the Fed raises rates, which puts pressure on lower quality credit. To be blunt, I'm sure you personally have a better sense or a better prediction of loan demand and credit quality in India than I do. Right now, I would prefer the insurance companies. Insurance is underpenetrated in India, and more Indians are going to be buying life insurance, et cetera. And I think that's going to actually be a pretty good market over the next 5 years.
Absolutely, Randy. In fact, the largest insurer is coming out with an IPO. So Life Insurance Corporation is coming out with an IPO in a couple of days' time. And they've priced it pretty decently as well. Just a follow through in terms of the financials as well. I think non-banking financial companies, NBFCs, as we call it, also become a talk of the town when you talk about financials. So how do you bind them? Are we really interested as per the O'Neill methodology in terms of NBFCs, or do we stick around still with the larger leaders in the financials or the banks?
I mean, the key on that, I don't know a lot about those stocks, so I want to be upfront about that. A lot of it is the very individual market and what actually their business is. And I mean, I would say that the three things you would focus on there is how fast are their markets growing? Are they helped or hurt by rising rates? Because we still think rates are headed up. Sure. And what kind of exposure do they have to credit quality? So that's another reason why we like the insurance companies. They don't have the same credit quality risks that the banks do. I want to be clear, I'm not predicting credit quality in India is getting ready to erode. I don't have a view on that. I just know that with the insurance companies, I don't have that same risk. There's a huge demand for the service, and they're structurally going to be better off with rising rates, I think, than some of the other financials.
No, no, absolutely. Point taken, Randy. In fact, when the quarter numbers are coming out for the larger banks, I think the performance relatively on a quarter-on-quarter on a sequential basis has been better as far as astrology is concerned. But you never know as how things pan out over the next few quarters. Now, one more question before we take VO queries, audience queries as well. I think the China factor that we kept it right at the end. Under lockdown, supply issues, do you think that can be one of the biggest risk factors for the global markets?
I think it's a huge risk factor, and it's a risk factor in two ways. It's a risk factor in terms of the supply chain. I think that's going to be, companies like Tesla and Apple get a lot of their parts from China. I think an underhyped part of that story, though, is Chinese demand. A lot of companies, including a lot of Indian companies, sell more into China than you may realize. And with a huge percentage, I may be wrong in the statistic. You probably have the statistic. I probably have this wrong. But something like 40%, I think, of the Chinese population is living in an area with some kind of COVID restriction. And in places like Shenzhen and Shanghai, they're under a ton of restrictions. This is a very, very, very big deal. I probably shouldn't say this, but editorially, it's very horrible what's happening to the population there. And so that's going to affect Chinese consumer demand. And I do worry about that impacting global company results in the second quarter and potentially the third quarter of the year. COVID cases are rising. The current variants spread very easily. While they're less severe in nature, a high percentage of the Chinese population either isn't vaccinated or is vaccinated with drugs that don't do a great job against the current variants. So I think the COVID problem in China is going to remain with us for the time being. And I think that's going to hurt demand. So one of the things we're trying to avoid investment-wise is we're trying to avoid companies that get a big part of their revenue from mainland China.
Absolutely, point taken. And in fact, folks, what Randy is trying to drive the point again and again, he mentioned it 2 times, is that quarter 2 and quarter 3, and this quarter and the next quarter, I think is going to be the most painful quarter. So what we've seen in the previous quarter, the worst 2 quarters probably in front of us, where we might see a lot of pressures coming from all counts. So Randy, I think we'll take a minute's break. I think I'll ask the audience, we'll open up the questions for the audience as well. Maybe they'll ask the questions that let's stack that up. So maybe in a minute's time we'll regroup and then I'll get those on. So Rucha, if you can put the chat engine on as well, so we can take a few questions that the folks have to ask Randy as well.
Yes, the chat engine is on.
So guys, if you want any questions to be asked, Randy is more than happy to answer that. You've got almost 6 odd minutes before we sign off. So maybe 2-3 questions. I'll pick up from the chat box to answer as well. So Prashant, Randy did speak about the sectors that he's bullish upon in India, right? I think EVs, renewables, financials, within financials, insurance companies is something that Randy likes. Uday, Randy's given his view for India, so I think I'll skip that one as well. Sorry. Randy's extremely bullish about India over a longer period of time. He clearly mentioned that, and then that's the way it is. So there's one question, Randy, from Sneh, one of our users. How do you see the path of the US dollar versus the INR? I think there were a couple of questions against that as well. So do we have any particular levels in mind?
I mean, in the short run, I think the US dollar is going higher. I mean, the Fed's going to be aggressive on rates probably in May and June. The market's already dialed it in. So when the market's forecasting, let me take a second to diverge on this.
Sure.
When the market's kind of forecasting that the Fed is going to raise interest rates 50 basis points in a particular month, it's kind of like a free raise for the Fed. It's already dialed into the market. It's easy for them to take that. They want to get rates higher. So he's likely to do it in May. I'm not sure if he'll do it in June, but he's going to push rates higher. An interest rate, in some ways, is a bribe for a foreign investor to hold your currency.
Yeah.
You're paying the foreign investor a higher price to hold your currency. And so I do think in the short run, the path is the dollar to trade higher versus the Indian rupee. I think that's going to be the case, at least for the next few months. That's actually going to help lower inflation in the US, which is going to longer term take pressure off the Fed, but it's going to be inflationary in other countries, in particular countries that import a lot of energy, because globally energy is priced in US dollars,
Yes.
particularly oil. So it's the rising dollar reduces inflation in the US. It actually raises inflation in economies that import a lot of energy.
Oh, absolutely. Absolutely, point taken. One question is about the real estate theme in India, Randy, I think. I mean, housing companies, construction companies. So how do you see that? Real estate developers, construction companies, home builders, so on and so forth.
This may be a useless answer. I don't have a great handle in the short run on housing in India. Long term, extremely bullish on it, extremely bullish. There is not enough housing in India. It is expensive relative to the per capita income. There is great demand. There is going to be pressure from the government to produce more housing for the population. I think it's a great secular play. I'm a big believer in real estate, both personally and professionally. So that is something I would encourage people to invest in, both in the stock market and personally over time, better than paying rent. So I think that's going to be a very strong market for India over the next 10 years. If you can take a little bit longer perspective and not hold me to the next 18 months, I think housing is going to be a great place to be in India. And I'm very, 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 very bullish about it.
And that also will include all the ancillary players, right? The plywood guys, the ceramic or the tile guys.
Again, it depends on the specific commodity, right? Those are going to go up and down. Right now, there's a lot of supply constraints on a lot of those raw materials. Once we get completely through the pandemic, I wouldn't be surprised to see those prices fall, even if demand for housing increases.
Okay.
Remember, a lot of that's been very supply constrained over the last 12 months. So you got to be a little bit careful, because the supply chain has been so constricted that those prices have moved up, even though housing creation is actually probably below, in fact, I'm sure it is below where it needs to be trend line, both in India and actually in the US as well.
Oh, absolutely. I think a couple of users have very structural queries, Randy. Are we looking at a global recession?
I mean, let me put it this way. We're looking at a global slowdown. Whether it's a recession or not, I don't know. I don't know if it really matters. If global growth is 1% to 2%, it may not technically be a recession, but it's not going to feel that great. So yeah, I think we're looking at a slowdown, and that slowdown is driven by the war. It's driven by COVID in China, and it's driven by commodity prices. Look at it this way. China's the second biggest economy. As their growth numbers come down dramatically, that alone pulls global growth estimates down. Now, perversely, over time, that'll take pressure off inflation in the Fed, and perversely, that'll actually cause investors to rotate back to growth stocks. I think next year could be a great year for growth stocks. I think we're not quite through all the pain of this global tightening cycle, but maybe this tightening cycle isn't going to last as long as we all thought it would at the beginning of the year. I hope this makes sense, what I'm trying to lay out.
No, absolutely. I think brilliant. I think one of the users absolutely loved it, and that's what the comment is on the chat box as well. And that's what we've always read about in our O'Neill studies as well. I think these recessions will ultimately bring out the new leaders and new winners to come through as well. One last question before we call it a day, Randy, because you've got a long day ahead of you as well.
Everybody needs to get to bed in India.
So FIs have been consistently selling in India, and I think that's a consistent question that has come through in the chat box as well. So from an institution or an FI perspective outside India, how do they view India right now? Is India a larger weightage, an equal weightage? How is India stacked up?
I think most professional investors view India very positively. People continue to believe, I think correctly, that it is one of the best secular growth stories in the world. I think that question of EM or emerging markets versus developed is a little bit of an issue in that when the markets are correcting and going to more what we call internally a quote unquote risk off environment, that takes money away from the emerging markets and more towards the more stable, theoretically developed markets. So I think, the next couple of quarters could be rocky for emerging markets, particularly as the dollar rises, increasing energy prices, putting pressure on margins. But I think with India in particular, that's a buying opportunity. Why is it a buying opportunity? It's a growing population. It's a growing per capita income. It's a growing middle class, which is great for any country. And it's a beneficiary of production moving from China into India. India is already a very close trading partner with the US. That relationship's going to get more important and expand, not decrease. So I think secularly, investors like it. I think the question is, how do we weather the storm right now of the war, COVID, and the Fed tightening? These things are not going to last forever. They're eventually, all three of them, going to ramp down. And I think that's going to create a really, really bullish environment for Indian equities. And, if I was investing in India personally on the long term, I would favor buying the larger cap growth names that I feel have great secular stories in places like healthcare, technology, specialty chemical, et cetera. So I would look for secular growers and would use market weakness to slowly build and probably dollar cost average into some of those names. That being said, next couple of quarters could be tough.
Oh, absolutely. Point taken, Randy. I think we'll call it today. And then it's been insightful. A lot of comments have actually come through in the chat box that it was a great presentation. Everybody loved your thoughts, not just on the US markets, on the Indian markets, on the Asian markets, on inflation, on macro issues, on commodities. I fired everything that I could, and I think you answered them all brilliantly. So thank you so much for your time. You have a great day ahead. Be safe, and we'll speak again. Thanks.
Okay, hope everybody has a great week. Hope everybody stays safe and everyone's family is safe over there. Thanks again for listening.
Thanks a ton. Thank you. And thank you, folks, for tuning in. It was a pleasure to have all you guys here late in the evening. But again, thanks to you all, and thanks to Randy as well. You guys be safe. Thanks, Randy.